And we've seen basically a repricing in the base rates over the past 18 months, especially in the U.S. by the Fed. And, right now, that's, contributing to very good returns for credit investors. What we really haven't seen is a complete shift in adjustment to equity returns yet, and I think that's what we're going to be waiting for. And really, if you start thinking about what the long-term macro is if you have persistent inflation in the U.S., which we have, and you have in Europe as well, the Fed and the ECB are at crossroads as to how they're going to prevent that from, how they're going to get that down. And until that kind of gets under control, we're going to have these higher base rates. As you roll into what you said is maybe a recessionary, but maybe just a slowdown in the economy, you have to say what's the next impact on corporates in general. And, we're starting to see some rise in defaults. And nothing troubling at the moment, but definitely a pickup in that. And over time, as you see a rise in defaults and recoveries are lower than historical levels from a credit perspective, that would lead me to believe that there's going to be increase in credit spreads, which we haven't seen yet. Credit spreads are still well below recessionary levels from a historic perspective at this time.
So your expectations, is that were global expectations that spreads are going to rise, or are there regions where this might actually happen sooner than later?
Well, I think generally we're seeing it, in Europe and North America, if you will, in particular. Not so much in Asia. I mean, the credit markets aren't as evolved there. But as a general thought, spreads are slightly wider in Europe relative to the U.S. in any event. So.
If you look to your business and also, again, the regions of the world, which would you say is the most attractive? Is it the United States? Is it Europe? Because for many companies, the U.S. seems to be the place to be right now.
Yeah, I would say for us on the credit side in particular, in the U.S., we're finding a lot of what I would call non-sponsor or family-owned businesses that are actually quite attractive from an investment perspective on the credit side, which is a little unusual because typically we'd mostly see that in Europe. In Europe in particular, we're seeing a bigger pickup on the sponsor side in terms of investment activity for us on the credit side, which is a little unusual. But also in Europe, as you know, there's a lot of family-owned, highly concentrated businesses, and we find those attractive as well.
Are those family-owned businesses, which traditionally are not very open to private equity, increasingly more open to your kind of business, also on the credit side?
Yeah, well, the reason they're open to us on the credit side is because unlike private equity, which is typically looking to do control equity deals, if you're dealing with us, we're able to structure transactions that allow those families to maintain control, but for us to provide capital for them to achieve their corporate objectives.
If you look at return levels, I'm curious, what return levels are you targeting in the market?
Yeah, well, I would say as a general matter that it depends on where you're on the capital structure. But today, if you look at basically senior loans, they are pricing, depending on the credit, the name, the sector, et cetera, in sort of the low double-digit range. And as you go further down the capital structure, more junior, if you will, you're getting into the high teens. So very attractive returns when you look relative to what equities have been historically.